So, hi everyone, this is Finance Meets Real Estate. So we meet here every Tuesday, 6:30 p.m. Eastern Time. And we usually have guest lecturers. So I've hosted over 100 amazing guests from the industry so far. And we do these sessions like today as well. So this is an online networking social. So the way we do it, we just basically exchange. So everybody shares their screen. So I just permissioned like everyone to be able to share their screen, so we can just kind of like exchange information and talk about ourselves. It can be a bit self-promotional, even that I think that's fine. So I'm gonna give it a start myself and introduce myself, and you guys feel free to go ahead after this. So okay, so a little bit about myself. So I'm founder of RealtyQuant. So RealtyQuant is a data analytics and investment firm in the real estate industry. So I previously used to purchase residential properties, and now I purchase apartment complexes. And so my mission is data-driven real estate investing. So how is it expressed? It has like different ways. So basically, there are a few products that I have that I do. So one is market valuations. Market valuations is essentially for every market in the US, if to assess if it's over, under, fairly valued. So essentially kind of gives you like a value investing framework, kind of similar to like Warren Buffett in the 80s with picking companies, but with picking markets in the housing market. So that's what this product is. So we cover like 2,800 US counties. It's quarterly data. Also, I have a product for lead generation for commercial multifamily, which is essentially about 100 cities. It covers about 30,000 off-market apartment complexes, and it pulls data from rental listings on those apartment complexes and kind of gauges which ones have more or less value add. And also I do like different presentations on data-driven investing. Let me just show you a little bit. And again, it's not going to be about myself, this meeting, so I'm going to let you guys speak after that as well. So hold on just 1 second. Yes, I do presentations like this one. Okay. So kind of like, yeah, like data-driven deal finding market selections, things like that. So it's usually like with Python, but I mean, there are other tools like one can dig into and like get some of the information, but I just kind of try to give a new perspective, like a new way to do things. And so I built many different tools, automate evaluation models, like different things. On the deal side, let me just see some of my experience. Okay, so these are some of the things I just mentioned, and I have like a data-driven investing course as well. It's all on realtyquant.com. And in the investing side, so I'm currently working on a 60 units syndication in Ithaca, New York. So that one's it's been taking a bit long. But yeah, these are some previous kind of smaller apartment complexes I purchased, and I used to do condominium conversions and other projects. These are I guess some of the guests at this webinar at Finance Meets Real Estate. We've had like Rod Cliff, like Neil Bawa, like some of the more known syndicators, I guess, and some prop tech guys as well. We've had like some other topics, kind of like on mindset and like economics and like taxation, asset protection, things like that, lending. Okay, hold on. Yeah, and I, like, as discussed with regards to like the housing market, like overvaluation and data-driven investing, I do like I have different features. I did a lecture at Fordham University, and I've done some radio shows, a couple of summits, and I think over 70 podcasts. Yeah, so there's we have a group on Facebook as well, actually. So I just so I don't miss it. So this channel, Finance Meets Real Estate, is a channel on YouTube. So here it is. So Finance Meets Real Estate on YouTube. So this is our channel, and there's also a Facebook group. So if you want to join, like, just search Finance Meets Real Estate Facebook. It's a Facebook group, and you're gonna find it. It's here as well. So yeah, so that's about myself. So previously, okay, just one thing. If you see, my previous background is in finance. So I was a financial engineer. I worked in finance for about a decade. I graduated from Columbia University in financial engineering. I used to manage with several colleagues like $90 billion in derivatives. And I've been an investor fully for the past few years, several years. And that. So, okay. So that's about myself. So now the next person can go. So I just stopped sharing my screen. So if you want to raise your hand, if you want to introduce yourself. Yeah. Ivo, do you want to go yourself?
Yeah, am I mute? Okay,
Yeah,
hey.
go ahead. Okay,
Hey.
sure. Yeah, how's it going?
Hi, everyone. Yeah, my name is Evelyn. Being in the industry for 12 years, I specialize in valuations, underwriting, asset management, acquisitions, working for a big fund, and pretty much that's my background right now, all commercial real estate.
So, Ivo, you're with which fund right now, actually?
With BlackRock.
Or you're with BlackRock? Yeah?
Yes.
Okay, so, sounds good. And you do like underwriting and like valuation or valuation only for commercial?
On the core funds. There are different funds, but I work on the core funds.
Okay.
Asset classes, mainly industrial, multifamily, office, and retail.
Okay, so it's across the different asset classes as well.
Yeah.
Okay, that's great. Sounds good. Yeah, Ivo is my friend as well. He's in New York City also. And that's great. Sounds good. And what is your interest now, Ivo, in terms of like projects and things like that at the moment? Like in your work, let's say.
Like with many investors, I would say value add deals, something that's less occupied, more opportunistic even deals. And I just have a lot of data, so that really helps me identify what my next investment can be.
So you guys, what kind of data do you guys have actually generally? Or
we use different I can share, but we use different consultant companies, and we are proprietary data on all market trends. Pretty much all assumptions that you can think you can put in a model, like lease terms, anything to pricing, meaning exit caps, vacancy assumptions, and discount rates.
Sounds good. That's great. Okay. Okay, so Ethan, do you want to go yourself next? I'm not sure if Ethan hears me. Since I saw you introduce yourself in the chat, so I'm not sure if you have a chance to share your background. Chris, do you wanna speak up?
Sure thing. I can tell you a little bit about ourselves. As my partners and I we're Discover Multifamily now. We work Cloud Capital, and we basically buy distressed real estate and rehab it, and we make it into nice homes. I can share my screen.
Yeah, sure. Yeah, go ahead. Please do.
So I'm the capital raiser in our group, and we buy distressed properties. We're primarily focused on Texas right now because we can scale there. We own in Houston, and we're looking in Dallas as well. And we just perform at a high level, and we're dedicated to our limited partners and our clients who invest with us. We always want to make sure that they're going to have the best experience as an investor. We're always communicating no matter what, the good, the bad, and the ugly, because everything doesn't go perfect. And when it does go bad, we'll describe what happened and how we're digging out of that hole. But and there's just a little bit about our team here, and then what we really do is we kind of before we go in and buy an apartment complex, we bought all our deals off market. We have really, really great banking relationships and great relationships with the brokers, because if you don't have good broker relationships, you're just not going to get any deals. So we've created a database of all the apartment complexes in Dallas and Houston and the submarkets, so we can underwrite and respond quickly. When a broker calls us, we'll have an answer within either a couple hours or the next day. So they'll know that we're not wasting their time. And that really, the brokers really like that, because they're commission based, and they're not going to have to call, like say a big bank where you have to go take it to a committee where they look at a host of things, and that takes like a week or two, and then they get back to them in a week or so later. We'll let them know with usually within a couple hours. So, and we developed our own software in-house, so we can actually perfect our underwriting skill set and make everything even quicker. So our systems in place now are able to really shine like best in class for the brokers, because then again, they know exactly when they call us, we're not going to joke around. We'll give them a solid answer, yes or no, and then that helps us gain an edge on the marketplace. So and our underwriting, everybody celebrates their underwriting pretty vigorously. We do as well. And we also created an asset management database that is best in class. And the way we look at business is the way that Wall Street looks at a business, except for our business is real estate. So we know where all our pennies are going at all times. And then when we use our asset management database to make our reports, they're also best in class, because then it's no fluff. It's very to the point, and it's all it's basically from the data that we obtained before we started till we finish. We use those points to strengthen our abilities to perform in a way that's consistent. So, and again, our modeling, we stress test everything. We want to really make sure that we're going to take over a property and we can make it perform. And then we also give the worst case scenario, and then we'll give the best case scenario, and then the medium case scenario. But we'll want to make sure that before we go in to buy a property, we'll look at the occupancy trends. We really do a deep dive on, how is the asset performing now? And it's usually performing poorly. So we can go in and turn that around really, really quickly. There's other things too. We can drive income, whether it's, from installing a RUBS program or getting the property up to the loss to lease up to the market level. So, and we make our growth assumptions with inflation and realistic, not, crazy high in the sky where we're not going to get a return on our investments. And then our operational team now, the reason why we're focusing on those 2 cities, we have team members now in those cities that can literally rinse and repeat. We're not going to have to go in and retrain all new staff. So they're really, really good at, marketing our properties, filling them up, and they really know how to control the expenses the way that we want them to do. And when they manage the asset, when we manage the asset, we know we have good team members who are helping us along the way. So, because they take their work and they get down to the little details that really makes us perform, and the whole team actually, work. So again, we really give our reporting like the way that big banks give their reporting to their clients. We do the exact same thing. And we want to make sure that they know where their money is going, how it's performing, and why it's performing the way it is. So, and again, we use our data to really focus in on the areas where we're focusing on, so we can, go where the great job growth areas are going, where it's favorable laws to the owners. And then we're operationally sound and, and process driven. So, and here's some before and afters, just to show the examples of what we're doing. And this particular property, it's at 98% pre-leased now. And this property is performing at Lakewood, it's performing at a 21%, and even way better than what we thought. So, and that's it. If anybody like to contact me, I'll put my name and number in the chat. So thank you very much, Stefan.
Yeah, no, sounds good. Sounds good. And so and you're saying that's in Dallas, and what are the 2 cities once again?
Say that one more time.
The 2 cities, the 2 markets you guys.
Dallas and Houston.
Dallas and Houston. Got it. Okay. Okay. And that's when you say like the reporting and all side and all the other aspects, that you guys have been doing that already for your residential projects, or it's only now for the commercial kind of apartment complex?
Yeah, we just do multifamily.
So you, okay, I see. Okay.
The reports to our investors. Sorry.
Okay, sounds good. Okay, sounds good. Thanks a lot. Thanks for introducing yourself. Appreciate it. And okay, Konstantin, do you want to go next?
Yeah, sure, I could go next. So quickly about me, I have a background in education, and I started investing in real estate about 6 years ago. So basically my strategy is based on my long-term goal. And then I also think about what is my specific goal with each purchase. So what I'm doing right now is I have about 28 doors, and I'm acquiring more, at this point, single-family residence, because that's kind of fitting with my long-term strategy, where I want to be for the next 5 to 7 years. Right now, I'm invested in 4 states. I have properties in Illinois, Ohio, New Jersey, New York. And these states are really working out for me at this point. And I know a lot of investors are talking about Texas. I just heard like Miami, Texas, but I really stay away from those expensive states. Because to me, it makes more sense to invest. Like right now, I'm buying properties in Toledo, Ohio. And 5 years ago, you could have purchased a property in Toledo under $10,000, which right now probably sells for close to 100. And something very interesting is happening in Toledo for the last couple of months. I spoke with a realtor there, and he told me that all of a sudden there's a competition in Toledo. And I was like, are you serious? We're not talking about Miami. We're not talking about, Texas, or we're not talking about California. We're just talking about Toledo. And he said, yes, you are correct. Now people are actually offering over asking price in Toledo, Ohio, which is very strange and kind of unbelievable, but things are happening there. And as a matter of fact, I was listening to Bigger Pockets today, and Stefan, that's how I met Stefan, to Bigger Pockets, by the way. So Bigger Pockets, there was one realtor, she's from St. Pete, Florida, and she was using Ohio like a narrative of making fun of Ohio. It's kind of it's a dead state. Nobody's making any money there. Nobody's making any deals. And she was talking about how it's okay to buy a property and to have zero cash flow and just to wait on appreciation. To me, that's like a kind of a naive strategy, because nobody knows where the appreciation is going to be, especially in Florida, when we both know that it's super overvalued at this point. So my strategy is basically acquiring properties in cash. If I need to fix them, I try to do that to a minimum when it's like a strategic value add, and then thinking about like getting a potential a cash flow. And I'm planning to probably acquire 8 more properties by the end of the year, and thinking about getting one property per month going forward. And again, that's going to depend on the condition, because the conditions of the market, they change so rapidly, and one have to think about what is your strategy. Just because it worked a year ago or during COVID doesn't mean it's going to work next year. So just thinking about what is your capacity to adapt to the changing conditions of the market, and that's going to make you or break you. Because like I see a lot of investors, they're using the same strategy from 3 years ago, 5 years ago, even 10 years ago, and they just going through the motions and thinking about that what worked yesterday is going to work tomorrow. And a lot of people right now are waiting for a recession. And what I think is we already going forward. And I mean, I don't know what the data is, like Stefan, you're expecting data, but my intuition tells me that at this point we're going up. So this whatever the recession or the pullback, I think is over. And I purchased my properties from auction.com. And for the last 2 years, I wasn't able to buy a single property because the prices were so high. There was so much competition. And I was just able, maybe like 3 months ago, I was able to get a property in Illinois. And just a couple of weeks ago, I was able to win a bid, like what I think is an appropriate price for me, again in Toledo. So there's some kind of a shift, like a lot of people are not using auction anymore, or a lot of people are thinking about recession. And, I'm looking in New York, I live in New York, and I'm thinking about what is happening in the market right now. There's like this kind of a freeze where nobody's selling and nobody's buying. And I was just talking to my son, who's also a realtor, and I'm asking him, like, why do you think is the reason that the real estate is so expensive and the prices keep on going up in New York? If you notice, like houses prices are going up, and we know the interest rates are probably more than double what they were like a year and a half ago, and that doesn't make any sense. And I just was able to share with him an article that's saying that a lot of people who are at 3% or even lower, they're now willing to sell their house. So the inventory is very, very low, and then therefore nobody's moving anywhere, and buyers are waiting and sellers are waiting, and it's just kind of a situation where I'm not really sure what's going to happen the next year or so. But everybody's going to tell you, oh, there's going to be a huge crash in real estate. Oh, there's going to be a huge recession. Like, I don't believe that.
Mm-hmm. But you think, so Konstantin, we may have had some conversation on that before. So you think when you say it's going to be up from here, just because kind of the expectation is the opposite in the market, and it's kind of like you're working as a trader, like a trader in the market kind of thing. But in real estate,
no,
that's your intuition, right? I mean,
no, I don't. I don't see it as a trade. I'm looking at the market is first. I feel comfortable now with certain markets, so I kind of know what to expect. I don't try to predict the market. Like, obviously, nobody can do that. Like, so if I see an opportunity, I probably gonna move towards that opportunity. I'm not afraid to go to markets that I've never been. I almost purchased a property in Indiana for the first time, and if the numbers make sense to me, then I'll take the risk. I believe it's a calculated risk. Obviously, I could lose money, and it has happened to me. Like, I lost money, like on a short term, not in the long term. In the long term, somehow in real estate, everything works out. And I spend more money than I wanted to on certain rehabs, but eventually, when the time passes by, it kind of help you erase the mistakes.
Mm-hmm. So But I mean, you mentioned, so when you say like you expect things to be up from here, so do you expect things to be up from here in Florida and Texas as well? Or you expect things to be up
like we all know,
here
50
in the
states, the 50
Northeast and
economies.
Midwest?
So I'm expecting like the markets that I invest, like Illinois and Ohio and New Jersey and New York. I expect the price to go up. Like you're not gonna catch me in Idaho. You're not gonna catch me in Colorado, California, Texas, or Miami, the Georgias, and the Carolinas. Maybe you catch me in Alabama though. Like I'm looking at Alabama as the next Idaho. Kind of people from Florida. People are moving out of Florida. Like retirees cannot afford Florida anymore. Florida is just as expensive as New York at this point. So I think they're looking for markets going north. And my prediction from 10 to 20 years is that the Midwest and like the Iron Belt are going to be the more popular states than
that's
the
what
South.
the data suggests too. That's what
that's just like don't tell that to anyone because people are going to laugh at you. If you mention that to like other real estate investors, they're going to think you're crazy.
Right, but that is what the data suggests. It doesn't matter what they think. That what the data, what valuation studies suggest, what fundamental analysis data suggests now is shift towards the Northeast and Midwest. That is what it suggests for 10 years ahead. So that is irrespective of what has been in the past. So that makes sense. I mean, yeah, if you were to say things go up from here in something like Illinois, I think that's pretty realistic actually. It can be because we're already 10 months from the peak, right? Kind of from the peak, call it in the broad.
See, I purchased my first property in Illinois about 3 years ago, and I haven't seen that property move. It was just it's up already like 10%. While my properties in Toledo, they're up maybe like I don't know, 500%.
Right. And that's why Illinois is the most undervalued state. It hasn't moved. It can be seen. And Ohio and Indiana, they moved up. They became like slight overvaluation, which is crazy because they were undervalued before. I mean, I'm just speaking again. This is my job. This is my job actually, assessing overvalued markets. If somebody wonders, that's actually kind of hobby, but it's my second job. So anyway, so that's that's interesting. Okay, I think I agree with most comments actually myself. So in that sense, so yeah, sounds good. Okay, Douglas, do you want to go next?
Sure, guys. Just real quick, I'm working on a debt fund. We're funding fix and flips, and also working on build to rent. I've got a build to rent deal we're working on in Lubbock, Texas, right now, but we're just early in the stages on that one.
So you're doing a build to rent there now, or taking part of? Yeah. Oh, that's great. I mean, that's pretty cool in terms of. I like the asset class. I mean, the build to rent asset class.
I think the setup is good as anything in real estate I've maybe ever seen in terms of the structural nature of how that looks.
Mm-hmm. And you're partnered with other syndicators on that one, or?
Yeah, absolutely. We got a builder that's local to the market, and then we're going to raise capital for him and get him set up.
Yeah, sounds good. That's nice. That's great. How have you been otherwise? What's new?
Really good. Just learning. A debt fund is a whole new world for me. So that's been a slow process, but it's been interesting.
So debt fund in the sense of what exactly?
Basically, instead of syndicating or doing a equity fund, we're doing the debt side. So we're lending out to fix and flips.
You guys are doing the lending yourself,
yes,
right?
Okay, that's right.
Yeah. Okay, no, that's cool. Oh, that's good.
Potentially gap funds and mezzanine also down the line, but right now primarily fix and flip.
So you actually do kind of like debt underwriting, sounds.
That's right.
How is that going?
Good. It's interesting watching the Fed. Trust me, I'm obsessive about what the Fed is doing, and so I think we're pretty close to done in terms of interest rate hikes right now is kind of my thesis, but
could be. I mean,
very interesting. Who knows? They could say, nope, sorry, we're going to keep cranking it. But I think they're seeing the effects of the rate hikes in the banking industry. So I think they're going to get some pushback on any further hikes right now. I think from internally, they're going to be like, I think we might need to calm down. It's kind of my thinking anyway.
Yeah. Right.
Yeah.
And so, right. So that's what you've been busy with. That's a lot. That's great.
Yeah. Good stuff.
How
But it's
is
good to see
your-
you, Stefan.
good to see you as well. How is your like social media, LinkedIn is going
Good.
well?
Just keep trying to plug away at it. It's
Yeah.
not really grown that much, but again, it just takes a while for that stuff.
Mm-hmm.
Yeah.
That's great. Sounds good. Well, good seeing you as well.
Good to see you.
Akhtar, do you have a minute? Do you wanna introduce yourself?
Yes.
Yeah, go ahead.
Hey. All right. Sorry, I'm with the kids picking them up from like after school programs and such.
That's good. Yeah.
Yeah. Well, nice to see you again, Stefan.
Nice.
So just a little bit about me. So I've been investing in real estate for since undergrad. At that time I was studying architecture and I was buying single family homes. Then I went on to study I went to grad school to do to study in real estate at Fordham. So I graduated from Fordham. And then I got really serious on investing in multifamily. So I do a lot of value add multifamily investments out in Philadelphia. And these are your 5-unit, 6-unit, 10-unit buildings. Buy them, gut them, reposition them, and then just hold them in a portfolio. So recently, and you and I chatted a bit about this, is that I focused a lot on data and just trying to acquire as much data as possible in order to identify patterns in the market. So that's what gets me. And what I've been working on is taking the years of experience and the way that I've been investing in some of the metrics that I look at. I put together, we're in prototype phase, a data analytics kind of a platform for real estate, but it's more very micro, so it's very granular. So what we look at is we go down to zip code level, county levels, even neighborhoods. Like we can actually identify the different neighborhoods, and we're really looking for the story of the neighborhood. So what we want to do is we want to be able to narrate what's happening in different neighborhoods, different cities, different zip codes over time, but most importantly in real time. So it's much more short-term data is what we're looking at, and we're using that to predict, because we believe that the consumer, it's the renter, they're far more dynamic than I think investors and landlords really think. Today, with the amount of technology, information, the way the jobs work, all this co-working and working from home, tenants tend to be far more dynamic and far more fast-paced when they're making decisions, and things change pretty rapidly. So we want to be on the forefront of that. So we've decided to really collect a ton of information, a ton of data we want to see the behavior of the consumer. In this case, it's the tenants. We want to understand their behavior, their financial health. We want to understand pretty much everything and anything they're doing, where they go to eat, where they play, where they work, what times they're congregating in certain areas, and be able to identify patterns out of that. And that's pretty much really it. So it's all in prototype phase now, and we're really getting somewhere with it.
So that's what you've been working on, actually, Akhtar. Yeah, that's yep,
that's what we've been working on. It's been like, I think it's been close to a year now, and I chatted with you a few times about it too. So we're hoping to have the prototype done probably by the end of this year. Really hoping to get that done, and then kind of go to start raising some capital and whatnot for the platform.
For the platform. But in terms of data, like on the consumer, kind of on tenants, essentially, right? Consumer is in the tenant in this case. And so what are your sources for that one? So essentially, just kind of, is it like social media or?
It's a lot. It's like we have probably about, right now we're working with about 10 different sources, but overall, we're probably going to have somewhere around maybe 30 different sources of data, which includes traditional and your alternative stuff. So it can go anything from social media, Yelp reviews, this is just a whole bunch of stuff that we're looking at, as down to even like say crime data, but live stream of crime data. So right now we are looking at in neighborhoods pretty much by the day, what's the crime that's happening, what's the severity of the crime, and just collecting all that information, right? To understand if a certain neighborhood or a county is going higher in crime, lower in crime, or is the crime severe or less severe, and trying to find patterns within that. So that's the type of stuff we're doing. Very granular, very it's storytelling. It's all about storytelling, and that's what we're focused on.
Right. Very granular, kind of predictive analytics, I guess, behavioral and so forth, right? That's awesome. That's great. Do you like hire people like online or to do some of the data gathering?
So what I've been doing is I've partnered with a former professor of mine who's also like really crazy into data and all of the stuff. So we basically I found an alignment with him, and then we kind of started to put this stuff together. As far as we haven't, we've been bootstrapping it and really doing all the work ourselves. We will hoping after prototype to get to the point of hiring folks to now take it to the next level and actually start putting things together. But for now it's been all bootstrap, all just him and I just really working through this. I've been using my own portfolio as one of the pieces to get a lot of data out of as well. So all the pretty much right now I have about a little over 50 units in Philadelphia in one neighborhood. So that was a good enough data set to collect for that one little zip code, right? So kind of taking that information, using that to now vet the information that's coming in and like relating it and saying, hey, all right, this stuff doesn't make sense, or this makes sense, and we're just constantly really just making this thing, punching out on this.
So you just kind of want to build a business like long term, right? And get just get to a startup. That's it. I mean, that's what you're doing, right? I mean, which is great. That's awesome.
So that's the because the reality is in the future, I'm sure you know this, that's why you're in the data side too, is as we move forward, there's no such a thing as intuition and gut feelings and any of that. That's all out the window. It's all about data. The more data we have, the more transparency we have. It's you've got to make those decisions based on the information that's available, and so that's what's driving us, is we're collecting all of that and getting down to a granular level
as much as possible, and then you'll kind of figure out who needs it, I guess, and so forth, right? Even
we do have a whole we've got a plan and everything, but right now we're kind of just we're just limiting the amount of like who we're going to target and things like that, because right now we're just focused on bringing all the information in, and then we'll decide after that. But we do have some plan in place as to who the target market's going to be and whatnot.
That's awesome. That's very exciting. Good to hear. Good to hear, Hector. That's great. So how have you been otherwise? Everything is good otherwise with you?
Otherwise, everything is good.
Still with the current news and
I've just finished one building now. It's a 6-unit, fully gutted, finished it, leasing it up. There's about 2 units left on that. Gonna refinance that soon. I just got the architect aboard last week for a 9-unit building that I'm planning to build ground up on a development site that I had. And then we're trying to get another deal done on a different development site that I already own out of Pittsburgh, and hoping to build like 4 townhouses there. So things are still as best as it could be in these rate environments, but everything is pretty much chugging along.
I thought you wanted to do more like stable condition, like condominium packages, maybe and things like that, instead of family that is older and so forth.
Correct. So there was the whole plan to go after these condos, but what I ended up doing is that while I was collecting all the data and information for that strategy, I realized that in a good way that the data part of it was probably 1,000 times more bigger than just buying a bunch of condos. So I did pivot. I pivoted because I realized the opportunity in creating this and the way that we're looking at it. And I just started to focus more on the prop tech of that information of that product than the condos at this point.
That's awesome. That's great. Okay, so yeah, good hearing from you, Victor. That's really nice.
Yeah, definitely. Yeah. All right.
Okay, so Eric, do you wanna share your story as well?
Sure. Can you hear me?
Actually, we have two Eric. So
oh,
Eric,
sorry.
No, go ahead. Yeah, no, go ahead. Yeah.
Oh, sorry. I think everybody's a little beyond where I am. I work in finance now, but I have a close relationship that does commercial development. I have, in my recent experience, helped with site selection or identifying properties, which historically were freestanding retail. So your Burger King's, McDonald's, AutoZone, properties like that. However, during COVID, the opportunities pivoted to the large multifamily space. So I have tried to see what I can do to help identify those properties. Historically, I would use, I'm in Massachusetts, so
I see.
I would use, I don't know what other states do, but Massachusetts, you can download the entire state parcel records. So I would identify and filter out residential properties and then use, if anybody's familiar with GIS or geographic information, some mapping software. And I would do things like overlay.
So just sorry to interrupt. So your background is in finance, but you kind of sounds like you know data science and stuff, right? In GIS.
I am very much in the finance space, but self-taught, SQL and kind of business intelligence through that. And I've tried to see what ways kind of use that knowledge or experience and outside of my current job, which, like I said, I have a relationship in real estate. So I thought, at least in my experience, a lot of people, or at least through my connection, don't know technology too well, obviously excluding this group because everybody seems to be very knowledgeable in that space, but not at least my close connections. So I tried to see what I could do to help in that space. So like I said, I would use data to help identify properties to target.
Right.
Easier for me to figure out in the freestanding retail space because I find it easier to, if you use a map, where's the collection of most commercial properties and you want to find something in that area on more trafficked roads.
I see. I see.
But I find it more difficult trying to do something similar on the large multifamily space. So I'm more just getting into what's available to help do that.
I see. So the GIS is being a bit more kind of, suitable for you, at least in terms of, they're kind of finding retail properties.
Yeah, because given the experience of having tenant contacts that want to be where the people are, you basically just have to get down to the areas where the largest collection of commercial properties are, because that should be where the people will be going. And then it's finding value add opportunities in those areas to put a tenant or a bank or so on and so forth. So that's my background. However, I'm trying to, like I said, do something similar on the large multifamily side. Right. And I'll add that, and it seems like a lot of people here have experience. My friend really has always done smaller financing deals with banks or using their own money. He basically took over his family's commercial business and they're only newly being introduced to syndication. So that's my own pet project now, is to it's a world that I'm not too familiar with and they are not too familiar with, but identifying the opportunities that you might have working with or within a syndication. So that's kind of my next project, to see if I can figure out any way that might be able to help the opportunities that we have. So
right. So are you interested in investing yourself, or that's kind of, you want to, that's a way to get on an investment team perhaps for
so I don't have the funds that he has. He makes his money through what historically was flips of the freestanding retail, and then the last couple of years he was flipping the entitlements to the large multifamily to the end developer. But the current deal now is using the entitlement or the town approved project as your equity into the next deal. So instead of him getting out, it's him staying in as part of the GP in the next deal. My space is trying to figure out, because I don't have the capital. What can I do with syndications, or help with that part to get a part of it?
Sure, yeah, no, that makes sense. Sounds like a good route actually for that, right? In that sense. And I know at the previous meeting we had, I know you had shared more about the entitlements kind of pursuit, and like entitlements is it's a field, if you will, like an investment niche and so forth, right? Which I found interesting actually.
And I would say that, I mean, not again excluding this group, most of my experience has been people who do syndications on homes or small multifamily. So I'm more interested in the commercial or larger multifamily space. And every time I bring that up, the people at least that I talk to kind of walk away quietly because it's over their head. So I don't have too much exposure with people that have the experience I'm looking for. So maybe somebody in this group might lend an ear or give an opportunity to help bring somebody along.
Got it. That's great. No, yeah, appreciate it. And the GIS is actually it's a great tool for real estate data science, if you will, right? I mean, so it's probably underutilized for sure. So yeah, there's definitely value to doing more of that, I'm sure. So yeah, that's great. Sounds good. Eric. So good to hear from you.
Thank you. You too.
Thanks. And I think I have Eric Vasilopoulos. Would you like to introduce yourself as well?
Sure, Stefan. How are you?
Yeah, good. How are you?
Yeah, so I'm here in New York, a local investor. Been investing for a little bit less than a year. I'm working together with my brother. He's mostly the money investor, and I do the value adds on the properties. And that's all pretty much. I mean, I'm looking to acquire some more properties and move forward. Eventually, down the line, I want to be a full-time investor and branch out to other states. Currently my 9-to-5 job, I'm a structural engineer, and I inspect bridges all over Queens.
I know you mentioned, Eric, we met at our in-person event in New York City, right? A couple of times, or at least once, I guess, right? And so I know you mentioned you were investing in Ridgewood, Queens before, in multi-family, right? Like around 6 units, I believe.
No, I try to keep it. My biggest one is 4 family. Just
so maybe we're okay. Sounds good. Yeah.
Yeah. So rent stabilization kicks in after, I believe, 5 units. So I try to stay below that.
Sure.
And mixed use properties as well. I invest in Ridgewood, Maspeth, Middle Village, and we recently acquired in Astoria. And I like keeping them, in the tri-state area nearby because they're self-managed.
Yeah, I mean, a fourplex in Astoria is like it's like $2 million or something. Right? That's expensive. I mean, or I don't know what yours is specifically, but it's not it's not an easy market, I'm sure, to do deals in as well. But that's so that's great. Yeah, I'm just kind of giving context to others, because in a way it's when you say a fourplex, it sounds like a small property, but it's not inexpensive at all over there. So
yeah, it is a pricey market. The ones about in Astoria, that they're smaller. There's a 3-family, and then the other one is a 2-family.
3 and 2.
And
okay.
Potentially, I could add more units to the 2-family. And the one in Maspeth, is a 4-family. Then we have some mixed use, maybe a store and a apartment or 2.
And that's, you're saying that's just like your family capital, like your brother and yourself, essentially.
Yeah, pretty much.
Capital anything. You're not capital raising.
Correct. We haven't raised anything. It's self-funded, and that's how we move forward, pretty much.
Got it. No, that's great. I mean, yeah, some of those neighborhoods. I mean, I don't know about Astoria, but I mean, Ridgewood and like Maspeth, right? So I guess they've been a bit on the rise, right? It's from what I hear, at least. Pretty hard to determine those things sometimes, but I mean, yeah, they've kind of been a bit on the rise, sounds like. So that's good. And
right. So pretty much Ridgewood is probably the the more rise they had in the last few years.
Right.
I guess there was a lot of investor money came in there, and you see what they're building, what kind of renovation they're doing, and it's obvious that it's from an investor side. Rents had hiked up just because it's Williamsburg went up a lot, and people started moving to Bushwick. Now Bushwick went high, and the next neighborhood is Ridgewood. So that's the direction people are moving.
Right. Yeah. No, that's what I heard as well. That seems to be the narrative now, that Ridgewood is kind of turning into the next Bushwick. So hopefully it does. Hopefully it does. The only thing I would think is if density a little bit interferes with any of those, because I know I had looked at some neighborhoods data a bit earlier, and I know that the top performers of the previous cycle, which were Williamsburg, it's like, I mean, we all know, right? Williamsburg and Greenpoint and Bed-Stuy, right? Roughly speaking, that are very dense, though, by the way. And so they're also, I mean, they're relatively dense, let's say. And so they actually were in the bottom quartile of performance, let's say, since COVID. I don't know, just saying. I don't know. Could be just due to COVID, or could be that it's a persistent trend. And then also this data is extremely wishy-washy because it's just from 0, and then they modified. Then I put another data set from them, they kind of modified it and so forth. But there may be a bit of just my intuition. My intuition as an investor is that other type of neighborhoods perform the next cycle, and it's kind of like places like where I live now by the beach, for instance, is one neighborhood called Arvern. That one showed very high. And I'm not invested here. I don't have any kind of incentive or anything, but that's just kind of what I have seen in terms of, so I don't know. So it's kind of the next Bushwick, but then I don't know if there will be a next Bushwick because I don't know if there is going to be the same type of neighborhoods that perform well, or rather the opposite type of neighborhoods perform well, that are not dense, that are for remote work or partial remote work or something like that. But that just kind of, I've been trying to see this in the data, but the data is unreliable because it's 0. So it's not like very easy to see it. So, but that's great. It sounds good, Eric. And yeah, that sounds pretty exciting progress for just 1 year, right? For you guys.
Yeah. When I started, I bought my first one was in mid-June. So it's been 11 months now. Nice. And then right after we kept going and, acquired a few more.
Well,
and yeah, pretty much we're going to refinance soon and time to find some more, pretty much.
Got it. Oh, that's amazing. And so you're doing like pretty big value add, sounds like, on each of them, right? It's always like a big rehab this way, or?
Actually, I prefer. It's any value add I could do. I try to buy 30% under value, and then whether it's tenants there already, and I can negotiate with them to bring up their rents. That's actually more beneficial. So I don't need to invest a lot of money on rehab.
I see.
And yeah, those kind of different scenarios, pretty much.
Those kind of things. I see. I understand. Oh, sounds good. That's great. Well, that's awesome. So good hearing from you as well.
Yeah, same here. I'll see you in person another time, I guess.
Yeah. We do every second Thursday of the month. Next month we're gonna be at the Delancey. So we're gonna be outdoors, Delancey rooftop in downtown.
Oh, changing location. Okay.
Yeah, new location just for the summer, only for the
Very
summer.
Nice.
Yeah.
Very nice. I'm excited.
Yeah, sounds great. So yeah, thanks. Thank you as well, and thanks to everyone else for joining here today and changing. So this is gonna be on YouTube if you want to just kind of get some of the information or on different people or connect and so forth. So yeah, thanks guys.
Hey, Stefan.
Yeah.
Hello.
Yeah.
I had a question. I had a question for Douglas. He say, I don't know if he's still on.
Sure. Let me. No, actually, I think he left. He left.
Okay.
Yeah. Sorry.
He mentioned about doing lending and whatnot, like lending to.
Yeah, he started
fix and flips.
Debt fund. Yeah, that's true. Okay, yeah.
So I just wanted to learn a little bit more about it. What is he like? Really a private lender, or just wanted to get some more information?
Yeah, it's a good question.
No, he started a fund.
It's a fund.
So
yeah.
are you a flipper?
Typically I buy and hold, but it depends really on the deal. I've only been doing it less than a year, so I haven't had to flip anything yet. But it really depends. You know, if I find a good opportunity for a single family, I don't really want to manage single families. Might flip those, but you know, funding will be something I need to get more.
So his fund is this: like you'll go in, buy a distressed property, and flip it, and then he gets a percentage. You get a percentage. It's a way to keep the fund going.
So pretty much, I bring the deal, or how does that work? I bring the deal, and he funds it.
Yep.
And he just gets a percentage as under what the LLC he goes under, or how does it work?
You'll have to make that deal with him, right? So, but he'll give you a percent. Like it's probably like similar to a hard money loan. You know what I mean? So.
Oh, okay.
But for you, it'd be non-recourse. You know what I mean? So there's a lot of good and bad. You know, so it's all, if you're going to be a flipper, it's all about speed. So
right.
But if you're going to buy and hold, what area are you in?
All over Queens, pretty much. Mostly New York City, Maspeth, Ridgewood, Middle Village, Astoria.
So you're flipping there. So what's your average price? Like 500 to 800 thou?
No, I haven't flipped anything yet. I just bought it and held. Again, I've been doing this for maybe 11 months. So
are you buying in New York?
Yeah.
Don't do that, dude. Sell that as fast as you can. Get out of there.
I know a lot of people are telling me.
I'm telling you, dude, I lived it. So I live in California and I grew up in New York, so I know them both. And we invest in Texas, Georgia, and Florida. I can tell you war stories, but just don't do it. It's too risky.
Yeah. The thing is,
okay,
Chris, I want to add, I mean, yeah, I would not disagree with the regulatory side of this for sure, but the tricky part to it, like the tricky part is that the most advantageous regulatory states now is like, let me share. I think I went to share this before, just for hopefully that kind of benefits somebody.
I don't mean to bemoan you guys or anything either. I've been doing this for
New York City is always all those states are, New York State is a risk, the whole state. I mean, I don't disagree with that in any way. Really.
The other thing too, guys, is I can stretch my dollar. If I was when I started 11 years ago, I was going to get a fourplex here for 1.2 million. I was going to have to put 800 into it.
Yeah.
And I bought the equivalent. I bought into a syndication, the equivalent of 38 units. So that just mitigated my risk tremendously. And that's what the other thing too, guys, I can read I know a bunch of stats. So if average single family home, when it's not rented and it's got to be rented upon the turn, is empty for 3 months.
Mm-hmm.
That's a lot. What happens if you need a roof, a boiler, an HVAC system? That's your profit for a year.
Yeah. I mean, I think, so I know, Chris, and I agree, because I mean, that's why already 15 years of investing in Florida and Texas and not the Northeast, right? That's where every big private equity fund and commercial investor has gone. Now, the flip side I want to say, so I'm not supporting investing in New York City per se. I mean, or not endorsing what I would say. I mean, everybody can take their own decision on their, in terms of regulatory risk. I agree with that. I personally have not invested in New York City in terms of the regulatory risk and rent control and so forth, but I have invested in the state and have taken on that risk, by the way, in upstate New York. And that is a risk too, because if you have something like
it's the whole state. And I grew up in Saugerties and Woodstock, upstate. So.
Kind of. It is the whole state sometimes, but not.
No, it's the whole state for New York and California. That you have rental laws. You guys know that?
No, and we know that. I mean, we deal with that on a daily basis, and I dealt with like all those things in New Jersey and so on and so forth. But what I'm trying to say is, like, Chris, there is a flip side to this. I'm just trying to introduce, and that's what I think Konstantin was sharing before. The flip side to this is the current time valuation. So if we're having this conversation in 2020, it's a different conversation. If we're having this conversation now, it's very different. And so here's the reason. So that I just want to introduce for this. So it's just like, here you go. So hold on one second. So these are studies at Realty.com. So that's my own studies, you can say, my company. I use like very many different sources. But here is, I just want to give you like some of the output of that. I've been doing this for 3 years. I've done lectures for this at many places, just saying this legit. It's not something I've spoken at this at 70 podcasts, some of the leading podcasts in the country. I've been at best ever real estate show with this and so on and so forth. But I just want to share it for because it's very, very different than what other syndicators do. It's very contrarian. And again, this is not an argument for regulatory risk. Regulatory risk is negative. It's very bad.
I'm just trying to make your dollar go further.
I know, but there is an issue with valuation in the Sun Belt.
Like what? Tell me.
Yeah, so here is the argument. So hold on. So now, so this study is of the housing market. So the housing market, this is the housing market at peak.
So are you talking single families?
Well, I can talk about commercial multifamily as well, but let me start with the housing market, and then I'll go to the commercial multifamily. So just one second, just hold on there, Chris. Sure. So just here is the. It's important to start with the housing market. Housing market is important. It's not to say that apartment complexes are, because they're valued differently, that they're fundamentally different. They're not fundamentally different just because they're valued different. And just because you have cap rates, and cap rates are driven off NOI growth and interest rates, sort of. And there's the flow of funds theory.
Can I tell you one thing? The people that just focus on cap rates don't really understand what they're doing.
Right.
The reason why is if you do the value add strategy, the real way you make your money is you buy a distressed property, you force in the appreciation, you get the tax savings by making sure your rehab costs are always higher than your taxable income. Then you'll do a cash out refi, and then you'll do a cost seg. Then you should be worried about the cap rate on the exit. But during the whole process, sure, we pay attention to it, but that's the real way you make the money.
Yeah, if you make money on a delta of the cap rate, not the cap rate, is what you're saying.
Yeah, so like all those other things, that's those other
forced appreciation, but you're I understand, but you're describing the business strategy. This is the same in all other private equity. This is not a real estate thing. You can play business valuation, private businesses. I know, I understand. So I understand. Again, this is a great point. It's very good to add. But the issue now in the housing market, let's start with the housing market. So issue now in the housing market is that, so these are the most overvalued US cities. So this is, if you're working, this is valuation, is this column here. It's just my spreadsheet, because I have it published in different places, but just my spreadsheet. Valuation at the second quarter of 2022. So Boise was the most overvalued city. That's before they actually started declining. I can actually get to that afterwards. So there was Boise, there was Austin, Texas, there was there is like Phoenix, Arizona, and so on and so forth. The top cities, they're all Western cities plus Florida and Texas. So it's all the West and Florida and Texas. Okay, this valuation is real. This valuation is real not if markets decline a lot. It's not a statement whether markets will decline a lot. It is real because it is a real deviation from income, population, housing supply in those markets, with all their enormous growth that has happened. So enormous growth in Austin, Texas, of population and population relative to housing supply, and certain income growth that corresponds to that population, housing supply thing, and so forth. And with that whole growth, Austin 62% overvalued at the peak. So I was talking about this thing for perhaps sometime before it happened, but mainly after the second quarter of 2021. And I
agree. I mean, you didn't even need to do this. You could just, I know this. It's crazy. All these places are. That's why it's so important to get these deals off market.
I understand, but it's not like you want to get a deal in a declining market.
But like these markets are not declining, so you just follow the job sources, right? Where are the jobs going?
The job sources. No. Okay.
Oh yes, you do, man. How many apartment complexes do you own?
Right, Chris.
If people have good jobs, I got to tell you, Stefan, if people have good jobs, they're going to be able to pay rent. It's a very basic philosophy.
No, understand? No, listen. I don't want to. Let me state correctly because I'm kind of misspeaking. It's not, you do follow the job growth, but at the end of the cycle, growth fundamentals correlate negatively with performance. What happens at the end of a market cycle? The more you're picking job growth, population growth, and all that, you pick decline. The more you're picking growth, you think you're picking growth, you pick decline. There's like, okay, there are tests for this. The way you test it is if you buy this overvaluation. Let's say you're buying this overvaluation 3 years before peak. Okay. And then you're testing 1 year ahead of performance, 5 year ahead performance, 10 year ahead performance. So this is a table. This is, by the way, it's not just words. I have all those studies. Okay, so this is like 1 year, 10 years.
You have to learn how to buy in all markets. You can't cherry pick the bottom. You know that, right?
Right. But the way you buy in all markets on the business side is finding a deal. On the market side, from a person of like somebody having kind of like finance background, which most sponsors do not have. Now, let's face it, so sponsors are location optimized. They do not pick markets well. Sponsors, when the market tanks, they tank. That's been like that with the most leading sponsors before global financial crisis. That is like that now as well.
Yeah, but you see, one of the reasons why you got to use the data, right? You got to use it to your advantage.
Right, but that is not data that seems to be available among sponsors, because okay, like my company sells it. I can tell like we sell this data to sponsors. Right. Okay, there I have syndicators in Idaho and syndicators in Texas that have bought this data. Okay, for instance.
Yeah,
okay, so
I've lived in a lot of these cities, so I
right. Okay, just give me an example. So they will let you look at it. Okay, they will look at it, but those are exceptions. But the majority of the industry doesn't use it. Where it ends up used is institutional level. Same studies are done by Moody's, by Bloomberg, but they're not done by syndicators, and syndicators don't even use them. Why they don't use them? I think there seems to be a reason it's better optimized this way. I think it makes just sense because they want to pick deals. They want to pick deals. They don't want to, it just makes sense to pick deals and they are serving their best social purpose by being local, by building their real estate agent relationships and so on and so forth. But that is not the big picture of where Austin is already down 10%. And that is the consideration to make here. And Austin is down 10% because since Q2 of 2022, because Q2 2022 was 62% overvalued. And that is the housing market. Okay, then the same study can be gone. And by the way, the way you buy continuously, because this is not some kind of scare thing in this framework, is what partly correlates to like we had like Konstantin actually on the call who was saying, okay, how he's speaking to Little, but Little is getting a little high or something, or a little bit bidding wars. And then he was buying like in Illinois and this kind of things. And the way you buy is you buy undervalued cities ahead of a recession. This is what you do. That's not what syndicators and all the big sponsors are doing.
You'd be crazy to buy in Elmira, New York.
Right. Okay.
I grew up in New York, dude. In New York, people are leaving left and right. You lost 2 congressmen. Did you know that? Right. What industry is there to support it? Like if you get 100 units or more, what's the industry that's going to support in Elmira, New York?
Maybe it's not enough. Then you balance those things. Then you're looking at, okay, which one of those actually has the ones to support? And this is, you have to keep on. This is
in Danville, Illinois. No way. There's just no way. And Illinois too is another like not
right.
Not
but those are the challenges
state.
One faces ahead of a recession, Chris. That's what happens. It's just not so nice. It's not so, you don't have like a smooth sale. You already are dealing with like not the nicest markets. They're not booming markets. That's why they ended up undervalued. But here's what happens in terms of ahead of in the future. So this is a table that they did. It's a very interesting. So, because if you say Elmira, New York in this, so this, let's say -4%. So what happens if you're buying like undervalued ranges, like here, -10, 0, they suck. Their business there sucks. You're right. There's declining population. Everything sucks. I agree. But what the data suggests is, and that's from 400 metro areas,
okay,
the more undervalued metro areas you bought ahead of both a mild and a severe recession, for each of 1 up to 10 years ahead, the more undervalued bucket of metro areas outperformed the next one, outperformed the next one. So where is, for instance, Austin? It's an example. I don't want to.
How did they outperform it? They didn't do it on cash flow. On a valuation?
On an appreciation, appreciation. Actually, the most surprising way.
But that's why you buy a distressed property and you force the appreciation. That's what you're missing out.
But forcing the. I don't think so, Chris. I think you're missing.
You bought a property a year ago and it's already worth $5 million more than we bought it for.
Forcing the appreciation, you're saying you're being a professional commercial investor. This is what it means. A professional commercial investor forces appreciation. I agree with that. I agree. This is, and you're saying, okay, regular housing market people, they don't know forcing appreciation. I agree. They're not dealing with valuation. They're not professional commercial investors. The question though is, where do you do it? If you start doing it in Texas and you're forcing appreciation, fine, you can do it, but you're going to deal with like a decline, already 10% in Austin and so on and so forth. Perhaps.
You don't understand. The market declines at 10% in Austin. Who cares? It's up 62%. So right. it's going to take a little bit of a haircut and you'll be fine.
Right. So here is what happens actually in markets like this that are 50-60%. It's not the 10% decline. It's what happens is that 10 years ahead, they are in very poor shape.
But
it's in comparison.
You don't understand the ways you're making the money along the ways, right? So.
Well, you could make money in other ways. That's a separate discussion. This is just a discussion.
No, the reason why you're making money on these properties. And even if it is minus when you sell, you've already made your money. Then you
no, but I'm saying that the argument that Austin is down 10%, it's about new deals, right? It's not about previous deals. Buying overvalued ahead of the peak is amazing, right? That's how you make money. I actually agree. The more overvalued you buy, the better. The more overvalued market you buy, the better. And that's being tested too. If you're buying the more overvalued markets ahead of peak, such as 2020, and you're buying 50% even overvalued, and you're going to make money for 1 year ahead or something like this, or 2 years ahead, right? And that's true. But if you start looking 5-10 years ahead, this is like order like physics. There's no better.
This is why you got to go to this is why jobs are important. You go.
No, that's why jobs are not important here.
I have to argue on that point. If people have especially if you're doing workforce housing, if people have good, diverse employment opportunities with the 2 to 10 mile radius from your apartment complex, you'll be okay. You'll be
okay in a revenue sense. But Chris, you're speaking. I think we shouldn't have this conversation.
No, I want to have the conversation.
No, because this conversation, we're not talking about the same things. You're talking about the business side. The business side is what's your revenue. This is an operator talk. Okay, this is an operator talk. This is not an operator talk. Okay, this is an investment manager that invests in operators talk.
But this is what I have when I talk to when I talk to like the banks, they want to know this stuff.
Right. But what I'm saying is, in a business sense, I agree. Revenue is important. That's where job growth is. Revenue is important. That's how you stay in a recession, by having revenue. Revenue declines a bit, but you stay, you have revenue. I agree. All I'm trying to say is this is new information. Okay, it's not something, I do not get the sense that that's something that most syndicators are aware of, which is that actually, no, buying a market in Texas that is 50% overvalued doesn't get you ahead when you buy it at 50%. It gets you to this relative performance, 16%, let's say.
I agree with that. Yeah. So this is the thing. That's why you're going to get the deals. One thing's
right, but you can get deals
off market from distressed landlords. So sorry.
Right. And by the way, another thing I just wanted to say, so okay, I understand. So let me just another thing I wanted to say is about commercial, because sometimes like this kind of conversation goes, oh, I was having this conversation that, oh, this is very much the housing market. Commercial very likely is very different, a very different distribution from this. By the way, interestingly, it does appear different from Houston, I think, where you are, Chris. But commercial is also a little bit less predictive. So let me show you how commercial works here in this similar approach of study. So I worked on like Freddie Mac. Hold on, like Freddie Mac data. I'm not able to with Zoom, I have an issue with seeing my tabs underneath. Hold on one second. And we're kind of way over time, but let me just. I just want to introduce something. Like, I know like these are very valuable things, Chris. I appreciate that. It's just there is more to it. This is the perfect business knowledge indeed that you're bringing here, and this is a different type of knowledge that's actually not in. This is not amongst any of the business operators. I do not know why, and it is there at the institutional level. That's it. So it seems like it's not necessary to be or whichever reason. I don't know exactly. So there you go. Or maybe they're not incentivized. They don't want to know about it. Or anyway. So hold on. So I was just trying to. I think I perhaps tweaked this a little bit.
These are single family?
No, this is commercial multifamily Freddie Mac commercial multifamily data. Apartment complexes, actually. So this is, and it's actually different, by the way, for Houston, which here appears to be fairly valued, which is interesting. I don't know but keep in mind that that's less to be trusted than the housing market data, because this data has lower predictive power. And so I don't know if it's actually so super reliable in that sense, but okay, hold on. This has been like a recent project of mine. So it's not very, they just had this. Okay.
Stefan, I have a question real quick. So
yeah, go ahead.
You say that over like say a 10-year period, those really undervalued markets tend to outperform. So I guess the question is,
which is surprising, right, Akhtar? That's actually surprising to me.
Yeah, but I have to pause it for that. But that means you're not making money for 10 years.
No. What do you mean? No, they're better in appreciation at every time point. At 1, 2, 3, at every time point they outperform. It's like this.
I guess the question is, does that mean that in that 10 years, perhaps there were more jobs that came into the market or something? What happens in that market over that time? I think that's a study that should be looked at, because yes. I think that it won't just appreciate by itself, right? There has to be some catalyst that happens, yes. And what is it? And
so some of it, you know what I think, Akhtar? Some of it is, you heard like Konstantin earlier today, Toledo, Ohio. I've been tracking like this for 3 years, this type of data. Every quarter for 3 years. Okay, Toledo, Ohio was undervalued a lot. So it's going to be like the cities that we just showed before that are also like pretty unattractive. And you heard like Konstantin, he's essentially trading Toledo, Ohio already for multiple years, like buying many houses like there, like and so forth. And again, that's the housing market. Yeah, that's not apartment. Okay, but that's just and so he already has seen like a lot of uptick, and his things appreciated a lot in Toledo, Ohio. And that is the example of when you buy very undervalued. I think I saw it. There was a market in Pennsylvania. It's going to take me some time. I can't remember off the top of the head. That I saw it spike in a similar way. Connecticut did this thing. Connecticut, that is like a total dump with declining population, was deeply undervalued, minus 15%, some counties. And I was looking at it and I was, okay, the same way, it's like super undervalued, but it's so horrible. I don't want to buy anything there. And it really appreciated a lot. Like they were selling investment properties left and right in Connecticut, and their prices got much higher. So they were selling, let's say, a sixplex for, I don't know, less than 300K. And then they started selling the same sixplex for 450K in like 2 years and something like that. So that is like part of, so there is definitely appetite. This is a market, like people, they start picking deals in those and so forth. So there is that for sure. Now, do their fundamentals improve? This is a different bet. I'm not betting that those markets are going to be the fundamentally strong markets next cycle. I'm not suggesting this. All I'm suggesting is that the delta, the relative delta,
the last 6 years, you could have been a fish and made money in all markets, right? So it's going to be interesting to see how these next 2 years compare. You know what I mean?
All right. No, I understand. I agree. And actually, so by the way, that's here. So sorry, so since I didn't. Okay, this one is something is I'm not able to sort it or whatever. But let's just look at
Jacksonville, a great market.
Yep, exactly. And this is commercial multifamily overvaluation at peak. Yeah, and so it's pretty similar market. So it's again Phoenix. It's a very like if I pull, I can actually I don't have it would take me a little bit of time to just look up the same cities in the housing market and map their valuation here. But the correlation of this overvaluation, this vector, to the same one in housing market, it's very, very high. It's actually quite close if you think about it. It's like Phoenix is a top 5 overvalued housing market, and it's a top in this just 25 city set. Commercial data is hard, it's hard. There isn't that much commercial data. That's Freddie Mac, 25 cities only. That's it. That's what you get. That's what I get, and that's it. So it's like Phoenix. You have, like all those other cities. But see, interestingly, on the bright side, by the way, Chris, Houston here is fairly valued. I'm surprised. But the tricky part is, I don't know if you can trust this so much. Predictive power of this is lower. Predictive power of housing market like this here study is huge. Like after global financial crisis, the predictiveness of these overvaluations and like what declines were it's close to 90%. It's close to 90% housing market. You can see it in this table. You can see it. You buy the most undervalued one. It declines only 4%, 6%. The most overvalued bucket, 52%. The correlation of this here is lower. So I was able to, you can see actually I have it in the study. Where is it? It was 77%. It sounds not so bad, but it's a different thing. 77% is just different. It's not the same. It's just not, it's not squared even, and it is different and it's weaker, but still the same pictures in the housing market, that these very undesirable, indeed, like Chris, you would say, like very undesirable with regulatory issues, cities that nobody wants, they are undervalued. Separately, there's separately this issue, it's the remote trend actually. So that's actually a little bit. But in terms of valuation, they're actually undervalued, and then it's like the West and the Sun Belt is where the overvaluation is this cycle. That's just what it is. Sun Belt, there's also Tennessee, but there's few people know, but there's also Tennessee is included in that. And but yeah, it's interesting. It looks a little bit different in commercial. Decline durations are lower in commercial. Average decline duration is 2.5 years. Average decline duration in the housing market is typically much higher, is like 4 to 6 years. So it's interesting. Lower decline duration, predictiveness of the overvaluation to actual declines is worse predictiveness, I guess, just the quality of the data or whatever. But then the other thing is, and that actually sucks. So the other thing is, I'm just, okay, here I have the summaries, never mind. Here you go. So this is, I think I did like slightly different model. So this is global financial crisis, same data set, global financial crisis overvaluation and what the decline was, and what was the correlation of overvaluation and decline. And that I quote, I actually view it as a weaker one. This is weak. Housing market is much easier, much more predictive. But what's interesting is it's not safe in apartment complexes. It appears to invest in undervalued that much. It appears undervalued.
Like, so for in the global financial crisis, right, when all those people were losing their homes, it was like 0.05% multifamily failed. So
right, they didn't have default rates much. I know it's quite interesting. Default rates were low, right? I know the narrative that I hear from syndicators is commercial multifamily fared better. Okay, but when I look at the data from Freddie Mac and also CoStar, same thing CoStar by the way, CoStar declines. So peak to bottom decline after global financial crisis, you just have it by regions. 48% peak to bottom decline of apartment complexes in the Midwest. 48%, 45% in the South, 20% in the Northeast, 36% in the West. Huge declines, by the way. And so I don't know, like
the declines, that's not a failure though, right?
Yeah, they didn't default. It's just the prices, right? Again, I know they can hold their asset because their asset is cash flowing. They hold their asset. And I know, but I just still want to kind of draw attention in a way to this because
the other thing too was, do you follow VC money in any of your models?
Which one you're saying, Chris?
Do you follow venture capital money in any of your models?
No, I don't have. No, this is way simpler than that. It's way simpler than venture capital following.
Well, that's one of the things that we look at. And
I see. Okay.
You got to, like, it sounds simple, but you follow the money and it's
like capital flows type.
Yes, because like
that is valuable. Yeah, that's always
one of the things that we also look at is we always we'll make sure that we meet with the local
good seeing you, Tar. Okay.
Yes, see you out there. So and they'll tell you a lot of data too that's so valuable.
So, right. Yeah.
That's not on their website.
Right. So. But just to kind of wrap this up, and I'm gonna I think we can if you guys have other comments, we can wrap up for today's so apartment complexes here, even if they were undervalued, some of them declined quite a bit actually. So that's interesting. That part doesn't get so much. Great. All right, Ivo. Have a good night. I don't know what he said.
I couldn't understand him. So.
Okay. Okay. Yeah. So it appears like so some of the hold on, I think I don't. That's the where is in summary. Yeah. So even if you had an undervalued city. And here in column I, there were still declines in the undervalued ones too. And that's not how the housing market performed. And so it seems like, to me, this is, again, I don't know if it's just the data set or just suggesting that actually the valuation might be a bit more volatile on apartment complexes. But I mean, on the positive side, revenue is safer. I mean, so you can just
that's why you got to look at it from a business standpoint, right? Where you're buying a distressed asset, right? You're pumping millions into this, and then you're reconstituting and rebuilding the business.
Right, but still, I mean, keep in mind, I understand, but still keep in mind that many people are doing the same forced appreciation model, and one still doesn't want to do it in a declining market, right? And let's say, even from an effort standpoint, you don't want to, let's say if you would make 20% on the forced appreciation, but to lose it on the market side, right? It's also, it's kind of like
I would have to see like what the buy was, and then I'd have to see what the, because the loss to lease, there's a lot of different things that you could, it's not really described here. So
you could have a market to what you
might be down, say like 44%, but that doesn't necessarily mean you're building, because you might be able to, you might have bought say for 18 and sell them for 24, right? And just because the market is down, but you've cash flowed and all along the way, you've captured all.
It's just a big. I agree. It's just kind of like going against the wind. It's like the opposite of. It's like the way Sunbelt really peaked up and performed amazing, and everybody was together with the wind, so to say, right? I mean, would be a little bit. It's a little bit going against the wind. That's all I'm saying. So I'm not saying you cannot make money. You can make money investing maybe here. And especially in a mild recession, you can definitely make money by picking good deals. It could be, But now, is it riskier or is it less likely? Perhaps, or is it kind of against the tailwinds of that market has like too big of a delta compared to other markets and like just where it's priced? And yes, and so this is just, those are just some things to kind of consider. But yeah, all the points like otherwise that you shared as far as like the business side, those are great. I know many people don't know these things. I know maybe because like I just for this group, because maybe I know many people in our group kind of do know like forced appreciation and all of that in that sense. But those are very, very good comments. I just want to say that there are arguments to buying in the Northeast now because from a valuation standpoint, it appears a suitable place, just the way the Midwest does. From our regulatory,
why would you do that if there's just no way? It's like because the jobs aren't there to support them, man. That's the thing.
These things change, Chris. This is a dynamic market. Things keep moving around. They keep moving around, and it's not
the biggest employer now outside of New York City, New York, right?
I understand, but that's what I'm trying to say. Okay, let me just just do one last screen share because I just really want to relate because this is a very big debate at the moment. Like for
and of course, over the last 10 years,
it's like a very, very big debate. Yeah. So all I'm trying to say is like Austin is the perfect example for me. Like, what is the most booming city in America now? It's Austin, right? Everybody knows Austin is like the most booming city in America, pretty much this cycle, right? So who is going to debate job growth in Austin? Nobody. It's humongous job growth. Everything is amazing and so on and so forth. Now, what happened in Austin being so amazing? And that's the thing I'm just trying to say. This is it's an insufficient, one has to consider the interplay of growth fundamentals and pricing. It's not only growth fundamentals, not only it has the best job growth, it has the best things. The question is, where is pricing relative to that? Because here's what happened in Austin once again. And again, this is just, I know it's the housing market.
I've owned in full cycle in Austin twice. So
right, yeah, which is amazing. That's good for you, right?
No, I know. So that's why I mean, like, so some of this stuff, of course, the last 8 years on the data, everything's going to look rosy. Right now, it's going to be the next 2 years. That's when we got to really look at, So
sure, yeah, I understand. And so the Austin decline in price since July of the housing market, according to Zero, that's just Zero. Okay, Zero, I know I have it actually in FHFA, the governmental source. It's a similar percentage. It's at 9.5% here. I mean, that's close to 10% in 9 months. This is huge. The housing market typically takes 4 to 6 years. 10% in 9 months.
But it's huge, but that's relative because who cares? It went up 62%. So it's still it's down 10%. Big deal. It's still up 52.
I agree. It's an argument for new acquisitions.
But so that's why it doesn't.
But it's an argument for new acquisitions, right? And the argument for new acquisitions is this one. That's what this is suggesting. New acquisitions in Austin perform like here, like this bucket, 50 to 60 bucket in a mild recession. Get the mild, by the 1990s is the mildest recession for the past 50 years. It's like real estate declined 0%. The currently real estate seems declining much more. So I don't know if that's going to be. And in that mildest recession that nobody knows, if you do a deeper study, if you separate valuation, you find out that actually 50 to 60% overall bucket performed extremely poorly for 10 years ahead. This is where Austin is. The odds of Austin as a housing market doing well over the next decade,
but that's
extremely well.
100%. But like, so what if it's down 10%?
No. But not only that, it's down 10%. It's not about not an argument of decline, Chris. It could decline only like here. It could decline very little even.
But the context of it then. So
no. It's the growth. It's an argument for growth. Its appreciation is going to be the weakest one, likely for 10 years ahead. This is what it's suggesting.
All right. That's why you do the value add strategy. So I got what you're saying.
Right. So that's what I'm saying. And again, this is just me. This is like this kind of I do this kind of lectures for other, for the syndicators. I've done this lecture for private equity funds as well. And they're just my part of my job. And, I understand the business side, business side is important, but this I'm just saying is a different perspective. Okay. So that's all. All right. Thanks guys. Appreciate it.
Man.
And thanks a lot. Yeah. Thanks.
Have a nice evening, brother.
Thanks, Stefan. Take care.
Thanks.
See you well.